What's up guys, and welcome back to Wall Street Millennial. In this channel, we cover all things stocks, trading, and weekly options trades, mainly focusing on massive failed YOLO attempts on high-growth meme stocks. But out of all the fails we've seen so far, none can even hold a candle to the scale and consistency of the fails of one person, Andrew Left from Citron Research. Andrew Left is an activist short seller who is famous for starting the research firm Citron Research, originally called StockLemon.com. In his early days, Andrew Left had some high-profile activist successes that built his name in the industry. For example, his highly publicized Valeant Pharmaceuticals report led to the SEC investigating the company for channel stuffing and fake sales. The ensuing resignation of longtime CEO Michael Pearson and 90% crash in stock price vindicated Andrew Left and gained him both admiration from finance professionals and hatred from the companies he targets. However, all good things must come to an end, and for Andrew Left, that meant his luck in picking out overvalued or fraudulent companies. In this video, we'll be going over some of his most insanely wrong short reports and how much money he lost on these positions, including a massive short call on Square, which has gone up almost 10 times since he initiated this short. Citron counts itself among the long list of short sellers who have lost tens of billions of dollars betting against Elon Musk, but Citron's story is a little unique. They first initiated their short position in 2016 with a $100 price target, which is equivalent to $20 now adjusting for the stock split and representing 50% downside at the time. Like many other short sellers, they thought Tesla would struggle to ramp up production and their demand would fall as they faced competition from legacy automakers. But unlike other short sellers, Citron didn't chase losses when the Model 3 started ramping up in 2018. They switched from a short position to a long position. In October of 2018, they published a report explaining their change of sentiment. They say they initiated a long position in Tesla because the Model 3 is crushing the competition and will come to dominate the auto industry once they can ramp up production. Andrew Left explains his rationale in this CNBC interview.
As a short seller, the most important thing you have to do is check your thesis all the time and see when things change. And when they started with Model 3 and the launch and the production and the numbers and how they were eating from the top and the bottom, and I realized it wasn't an EV revolution in this country. It was a Tesla revolution. The people want to own the Teslas. And if Steve Wozniak doesn't like his Tesla, that's fine. There's plenty of people who want them.
Citron shorted Tesla in 2016, held the position for a couple years while the stock moved sideways, and converted to a long position before the stock ripped higher. So one might think that Andrew Left is a genius who called Tesla's meteoric rise, but that would be wrong. He held the position until February of 2020 and made 126%, more than doubling his money. But instead of taking his profits and calling it a day, he converted to a short position, saying the stock price has gone up too high and was a bubble. Obviously, that couldn't have been farther from the truth, and Tesla stock has increased more than 500% since that time as the company has consistently exceeded expectations on deliveries and completed the Shanghai Gigafactory. His short position in 2020 wiped out all the gains 4 times over. So Citron's pulled off the impressive feat of squandering a 126% gain by making the same mistake twice in shorting Tesla for a second time.
They fool me, we can't get fooled again.
Citron's next failure is Shopify. If you're unfamiliar, Shopify hosts an easy-to-use e-commerce platform where any small business can make a professional-looking e-commerce website, requiring minimal technical know-how to operate. Shopify also handles all the payments, marketing, and fulfillment on behalf of the client, making it easy to use all-in-one platform. In 2017, Citron put out a short report on Shopify accusing them of fraudulent marketing practices to sign on new customers. They thought the FTC would crack down on Shopify and initiated a price target of $60 per share, which represented roughly 40% downside at the time. At the crux of their argument is Shopify's affiliate marketing program. This program allows influencers to market Shopify to make up to $2,000 of commission for each new merchant that signs up for Shopify through their affiliate link. Citron said that this was essentially a pyramid scheme. Influencers would lie about how much money they made on Shopify to get more referrals, and the referees would make money by referring even more people. Here's Citron founder Andrew Left giving an interview on Bloomberg explaining his short position and trying to pump the stock downward.
25,000 is Shopify Advanced. What this story is about is who is the other 470,000 Shopify users. And that is what has never been discussed on Wall Street beforehand. And as I show and I prove, these are people who have bought into become a millionaire at home, get rich quick, and promises that completely violate every FTC rule imaginable. As it's all in the report, the correlations and the parallels to Herbalife. It's amazing that this has gone on.
But as it turns out, Citron was missing the forest through the trees. They were hyper-focused on Shopify's affiliate marketing program and failed to see that their actual product was extremely valuable and a complete game changer for thousands of small businesses. Shopify allows any small business owner to make an online website and start making e-commerce sales even if they have very little technical know-how. While they acquired many of their customers through their affiliate program, the customers stayed with Shopify because it is so valuable at driving e-commerce sales. Currently, over 1 million small businesses around the world use Shopify, and they have cumulatively earned over $200 billion of revenue on the platform. Every year, e-commerce takes more and more share from brick-and-mortar retail, and this trend has only been accelerated by the pandemic. It is becoming more and more important to small businesses to develop an e-commerce presence. Shopify has gained market share and is now the second largest e-commerce platform in the US, second only to Amazon. And the pandemic has benefited them, with revenue almost doubling in the third quarter of 2020. Shopify's revenue growth and innovation have made its stock one of the best investments of the past 5 years. Needless to say, Citron's short position on Shopify was a huge disaster, with shares more than 10xing since they published their short report. On April 20th of 2018, Andrew Left put out a price target of $30 on the payments information technology company Square. At the time, Square was something of a meme stock and had risen over 300% in the 2 years leading up to that point. Square is a payment services and mobile payments company that makes software and hardware to help small businesses accept payments from customers. It was co-founded by Jack Dorsey, who also founded Twitter. Since even before Square went public in 2015, it has experienced extremely fast growth. Its revenue has increased almost every quarter, increasing from $200 million in quarterly revenue in 2014, almost tenfold, to almost $2 billion in the second quarter of 2020. Its gross profit, which is its revenue after all costs of revenue are subtracted, also grew dramatically, from about $60 million per quarter in 2014 to almost $600 million per quarter in 2020. Meanwhile, Andrew Left put a price target of 36% below Square's current price at the time, saying that the company is just a collection of yawn-worthy businesses, and the Wall Street bulls were, quote, drunk on Bitcoin nonsense. He was likely referring to Square's pivot to being more friendly to cryptocurrency transactions, and specifically to Bitcoin. Founder Jack Dorsey is a longtime believer in Bitcoin, and just recently, Square announced it was investing significant capital in Bitcoin, following in the footsteps of MicroStrategy CEO Michael Saylor. In an interview with CNBC, Andrew Left explains his reasoning as to why he thought it was a good idea to short such a high-growth company.
It's a very small part of the business, but it's a very large part of the narrative. The truth is it's a credit card processing company that actually has take rates that will probably contract over time, like every processing company. So where do you go? You say we're the SaaS company, even though you have many companies within that are not SaaS companies. You say we're going to do things with Bitcoin. You do everything to keep the focus away from the core business. And even what I heard right there, Bitcoin is a hook. We're looking to do things with Bitcoin. This is a $19 billion company. So we're not talking about a little company that might figure out Bitcoin in the future. Let's look at their business, their core business, and where's this business going to be in 2 or 3 years, and whether or not you're worth 15 times revenues.
Sure.
Since his short call, Square's stock price has never hit the $30 price target, and has instead skyrocketed more than 400% to $241 per share today. Clearly, this call did not go as Andrew Left had hoped. Alright guys, that wraps it up for this video. If you like the content, make sure to leave a like and subscribe to the channel. Also make sure to check us out on TikTok, link in the description below. If you have any thoughts on Citron or any other short selling fails you'd like to see a video about, let us know in the comments section below. As always, thank you so much for watching this video. Wall Street Millennial, signing out.